The Money Merge account software has an auto bill pay feature. It's done by a third-party servicer, not through United First Financial. Third-party bill servicer. You can set up your money path, your routing, and it will actually do your bill pay for you, requesting your response and your interaction if you want to proceed and pay bills at that time. It has text messaging interactions where you can actually text message your folders or your categories and find out how much money you still have remaining, or you could text and find out what would be the impact if I was to purchase an item. How would it impact my overall picture with years and months to pay off as far as my true cost? How much money would it cost me with relationship to the Money Merge account program? If I'm thinking of making a purchase, I can go in and actually ask the software, what's the best time to buy this? Give it the equation of how much money I'm going to spend and when I want to do it, and it'll come back and tell me, hey, this is the best time for you to do that. True cost evaluation is money spent or money applied to the line of credit. How much money am I saving or how much money am I spending by either giving that money to the line of credit through the Money Merge account or by spending that money out of the line of credit? It gives me a direct correlation of my financial decisions with respect to the Money Merge account. The software is simple to update. It provides a tracking tool. It functions as an account register, and all it wants to know is how much money is coming in and how much money is going out. It tracks your monthly budget, and it includes continuous customer support, coaching, and education. Everything that we've been talking about up to this point has been very generic. $200,000 mortgages, $5,000 of income. I would like to move into a client that was part of our Denver test market. This client, we're going to call her Mary, and these are actual screenshots of her situation of when she first got on the product. Mary entered the product back in March of 2005, actually signed up in February, started utilizing the product moving into March. As we can see, Mary is listed here. And if we look here, Mary was paid semi-monthly on the 1st and the 15th, and we see that her income on each pay was $1,136.49. So she roughly was making about $2,273 a month. She had a mortgage payment of $927.08, and she had designated her living expenses at about $1,000 per month. I think we could look at this situation and say that Mary represents a good chunk of middle America, an individual with limited resources and limited means. Right here with Mary, what we had told her is that if she followed that parameter, if she deposited $2,272 into her line of credit, if she spent $1,927 per month, she would pay her mortgage off on January 2018 in 11.917 months. This was Mary's first little line item that ever popped up for her and told her that she wanted her to send $3,870.32 from the line of credit payable to her first mortgage. Again, to compress the balance on the first mortgage, save her money and interest, and trade closed-end interest charges for open-end finances charges on the line of credit. Now, just want to ask you, for somebody like Mary, would $3,870.32 be a lot of money? I think we can all agree. But let's see how this all panned out for Mary. If we click on the Money Merge Account tab, it's going to take us over to a ledger and show us what this 1 year in activity looked like. When we started Mary on the program, on the date of activation, she had 28 years remaining on a 30-year mortgage. The balance at the time of activation was $136,058.76. Mary made her first payment on March 2005. She was now on the Money Merge Account program, and she made her first payment utilizing her line of credit towards her primary mortgage. When she made that payment, $156.92 went to principal. On April 7th, 2005, she made another payment, and her principal contribution increased by 69 cents to $157.61. That's a principal increase of 69 cents. Now, if we remember our $200,000 example, the principal contribution was supposed to increase by $1. In her case, it would be 69 cents. On April 15th of 2005, the software came online and told Mary to send $1,092.99 from her line of credit payable to her primary mortgage. Now, April is usually tax time. Mary received a tax return. Where do you think Mary sent that money? Exactly. She sent the money directly to her line of credit. Upon doing so, it alerted the line of credit. Remember, it's looking at every penny that comes in. It's filtering this through factorial math, through interest cancellation, through the algorithms, through the math engines. And it says, wait, hold on, you've got more money. This is not money I anticipated. So on April 30th, it said, let's go ahead and send another $1,534.13. Now remember, Mary only makes $22.72 a month. That is a lot of money to Mary. But Mary moves forward knowing that the Money Merge Account program is going to operate for her. What we see is that in May and June, the software tells Mary to not send any additional money to principal, just make her regular standard payment. The reason the software is doing that is the software will take portions of money from the line of credit and make it payable to the debt that it is designating, the strategic debt payoff. The balance will go up a little bit on the line of credit, and what the software will do is over the next few months, dependent on the client's income, expenses, and discretionary income, will focus the income potential towards that debt and drive down the dollar amount that they just used from the line of credit. So the software tells them to take a portion of money from the line of credit, pay it to the designated debt, and then the software will say, okay, let's just make our regular payments and let's concentrate our discretionary income and our income towards the line of credit and pay that balance back down. When that balance gets paid back down to a number that the computer recognizes, the software recognizes for that client, it says, okay, let's do it again. On July 3rd, 2005, the software told her to send $5,169.57. The reason for such a drastic increase in the dollar amount of that funds transfer from the line of credit to the primary mortgage is because of that additional money that the software read back in April. It says, you know what, if you're going to give me money like this, let's get this thing going and let's send $5,000. But as we can see, in August, September, October, November, December, January, and February, the software does not tell her to send any additional money to the mortgage or to a strategic debt payoff because it wants to have time to pay that $5,169 back down on the line of credit using the client's available resources. But what we do see is that by February 12, 2006, her principal contribution has increased from $156.92 on March 3, 2005 to $199.92 as of February 2006. That's an increase of $43 in 1 year. Now remember, it was supposed to increase by 69 cents a month. Let's see a comparison of what that looks like. On the Money Merge Account program with a start balance of $136,058, in 1 year, Mary was able to achieve a balance of $126,032 with limited resources and limited means. If Mary had followed the bank's conventional amortization schedule and just made every payment on time, it would have taken her 4.7 years to reach a balance of $126,193. If Mary had followed that schedule and made every payment on time for 30 years, she would be scheduled to pay back, in addition to the $136,000 in principal, $134,726 in interest alone. Mary stays on track with the Money Merge Account program. She will pay off her mortgage and her line of credit, no money owed, 2-0 in 11.917 years, and pay a combined total interest between the line of credit and the mortgage of $45,159. Total interest savings represented as $89,566. This is the awesome power of the Money Merge Account program. This is why we're so excited. And there's never been a more ripe time in the economy than where we're at today. America's total outstanding public debt is $9.5 trillion as of July 23rd. And if you can see the little guy in the wheel, it's just like we're spinning our wheels and going nowhere. We've been conditioned. This is a result of being conditioned to believe that we can have it now and pay for it later. After 2 years, we have changed our customers' lives here at United First Financial with the power of the Money Merge Account by giving back over $153